Hey everyone, how's it going? Well, good evening, everyone. Well, good morning, good afternoon, good evening, wherever you are. And today is Tuesday, June 14. I got quite a few messages and email from my investor group and asking me, hey, what's going on? The market has been going crazy. Up and down, well, mostly down in the past 4 or 5 sessions. And also all these inflation and rate hikes and what's going on. What happened? Why it happened? What should we expect next? What should we do? Seems like everything is totally out of whack. Yes, I feel you. So let me take a few minutes. Hopefully, in this quick video, I'll give everybody an update. Hopefully, I'll give you an idea of what's going on and why things happen and what to expect, especially tomorrow, and what should we do as investors, right? So so the market has been down in the past few sessions, especially since last Friday. So what happened last Friday? Well, last Friday, the U.S. government released the latest data, the CPI, or Consumer Price Index. So basically, the CPI was much harder than expected, running at 8.6%. So, and since then, the market has been dropping like a rock. So I'm going to go through and try to help everybody to understand, why it happened that way. But first of all, well, let me just show you a few graphs here as I show here. This is the 2-year charts of Dow Jones Industrial Average, just to give everybody an idea of where we came from and where we're heading, right? As you can see that, Dow Jones peaked in the first week of January and has been trending down since then. As you can see that lower peak, lower bottom, lower floor, and today even fell through, the floor, right? This channel. So if we take a look at, let's say, S&P 500, same thing, similarly, right? As you can see that in the past 2 years, it's been trending up all the way to 4,800 and peaked on January 5th, and then has been coming down, even though it has some rally to try to get back up, but then again, lower peak, lower trough, and then now even break through the floor, right, from the bottom part of the channel. And if we take a look at the Nasdaq, right, so and Nasdaq, and same thing, even dropping even more, as you can see that same trend. Or even if we look at the small and medium size cap, the Russell 2000, and even messier and dropping even more, and you get the idea. Okay, so what happened? Well, let me explain. Let me show you this. This is the latest release from last Friday by the US government, the latest Consumer Price Index, CPI. And what it's showing is that the CPI has been climbing. That's showing a strong inflation. And it peaked at March, and then it came down a little bit in April. So everybody in the market has been expecting and hoping that the CPI would be, coming down a little bit more moderate. But then, of course, it went back up, and that reflects in May, the Consumer Price Index overall is running at 8.6, much higher or harder than what the market expect. And in fact, if you look at the breakdown, okay, 8.6% is the overall price index. And if you look at food alone, it actually is 10.1%. And if you look at the energy is 34.6%. If we look at specifically gasoline, okay, it's 48.7, close to 50%. I think we all feel that, right? And other than, I think typically in any given household, other than mortgages or rent, the next biggest expense is, of course, food and energy. So if we look at food and energy alone, right, 10.1 and close to 50%, let alone all the other subcategories, as you can see here, I think the Federal Reserve realized that, inflation remained the number one problem. And I think everybody had enough of it. If some of you have followed my program, you probably remember last summer, July, August 2021, I reported that on average household for sending kids back to school during last summer, the average expense is 40% higher than the year before, and that was before inflation became a problem. We were talking about sending our kids back to school, everything from computer, electronic, backpack, clothing, sneakers, running shoes, everything. It costs 40% more than the year before, right? Now, let's say that's one-time spending, kids back to school. However, everyday spending, everything from, housing, food and energy, and everything else, it become a problem, huge problem. Other than the CPI subsequently, and this is also another released by the US government on the so-called PPI. And PPI basically is producers price index. What it really measures is manufacturers or any type of goods and services producer, their price index. That means what they pay in order to produce the goods they're selling or the services that they're providing. So if we look at the May data here, goods is running at about 1.4%, and services is running at about 0.8%. However, these are month-over-month data. Compared to the year before, if we're looking at year over year, we're talking about 10.8%. So no wonder all the manufacturer, they're raising their price because they are paying more. It costs them more to produce the goods, the manufacturers, whatever they're selling, and also to offer their service, right? So everything is higher and higher. So just to give you an idea of where all those numbers come from. Now, one thing I do want to bring it to your attention is that although these are the number officially released by the government, I always, tell people that, how to interpret these numbers. Whenever you hear about good news, chances are a part of it is true, and then a portion of it is exaggerated. Right? Whenever there's good news, people tend to exaggerate the good news and make it sound better than it really is, right? So when you deal with good news, simply take a discount, Whatever you hear, chances are not as good as what you hear. I don't know, take a 30% discount, 50% discount, chances are, those are the right number. Now, on the opposite side, when it comes to bad news, when we're looking at inflation rates at about 8.6%, now these are the official numbers. There are a lot of exceptions in the measurement, and without going into details, what I can say is that there are a lot of things not being incorporated into these numbers. So whenever you hear about bad news, like in this case, inflation rates, CPI, chances are these numbers already contain, or people are trying to, doesn't matter whether it's the government's number or a corporate releasing their bad news, or whether your kids telling you something bad news from school, or your friend, your parents, your extended family delivering bad news. Chances are they already trying to, downplay it. In other words, if it's showing 8.6, the real inflation rate is much, much higher than 8.6. I can almost guarantee that it's double digit. It could be more than 10, more than 12. Some people saying that it's more than 15%. You know it, I know it. When we go to the shop, go to the store, go to supermarket, go to the service station to fuel up our car, doesn't matter. Or even when we go online to order something, things are so much more expensive. All right, so why it happened? Okay, so what happened? What causes that? Well, without going again into detail, primarily three major reasons. Well, in the past couple of years, because of the pandemic, the government is trying to support the economy, trying to support a lot of the people who lost their job, who were financially impacted due to the COVID lockdown and things like that. So overall, the U.S. government alone, okay, let alone other country, okay, other jurisdiction. So the U.S. government, the Federal Reserve alone, have pumped close to $7 trillion into the economy. Everything from printing money, handing out money, to buying asset. The Federal Reserve is actually supporting the market by buying everything from bonds and equity, and even mortgages as well. So supporting the market. So there's so much liquidity, right, into the economy. So everybody has so much money in their pocket. That's what That's why the market is running so hot, right? So that's one thing, one of the cause of inflation. Secondly, of course, the war over in Ukraine. Well, that's certainly a humanity tragedy. There's no question about that. But it also led to various commodity price, increase, and that's part of the inflation as well. And also, the second largest economy in the world in China, and they have a zero COVID policy. So in the past few months, they have been implementing the extended lockdown. So I think, this supply chain disruption is certainly impacting the rest of the world. Okay, I think the impact is yet to be fully realized here, because China right now is just starting to slowly reopening, right? So we're yet to experience, the worst part of that impact. So everything that lead to, everything is a lot more expensive. So that's part of the reason. So now what happened? I think you feel it, everyone feel it, and I think a lot of the people, around the world, especially here in U.S. and Canada, is struggling, to survive every day. I think from the number that I read is that like close to 49% of the people are living from paycheck to paycheck. So given how expensive things are, and people are really, really struggling in a short term, okay, on a daily basis. Now, in the long term, we all suffer, okay, we all lose money. Just to give you an idea, if inflation is running at about 10% per year, what we really looking at, what it really means to us, every one of us, is that in 7 years, the money that we have, the money that we think we have, the value of it would be reduced by 50% within 7 years. Okay? Remember this, a 10% inflation rate will reduce our net worth by half within 7 years. As simple as that. At 8%, let's say if the government is right at 8 or 8.6%, our net worth, whatever money that we have in the bank, we save up or whatever, for retirement, for our financial freedom day, or to go on our bucket list trip, whatever that money we put away, it would be reduced by 50% within 8 years if inflation rates continue to run at 8%, okay? Or at the high end, if the real inflation, as what a lot of the people are talking about, is that it's more than 10%. In fact, it's 15% or even more, okay? If we're looking at truly 15%, we're talking about our money would be reduced by half, 50%, within 5 years. Okay, 5 years. Okay, so that's how significant inflation is. No wonder everybody is getting very upset. It becomes a societal problem, a society issue. And the Federal Reserve knows it. The government knows it. So that's why the number one mandate for the Federal Reserve is to get inflation under control. So that's why tomorrow, on Wednesday, June 15th, the Federal Reserve will determine the next rate hike. Now, 50 basis points or 0.5% is a given. Now, the market is talking about that they should really raise by 75 basis points or even 100 basis points, which is 0.75% to 1%. Now, 1% probably is a long shot because the Fed may lose credibility if they have to go as far as 1%. 75 possible, okay? Now, there's no point for us to speculate here. It doesn't matter if they raise 50, 75, or 100 basis points tomorrow. The markets basically is saying that, okay, well, now the Federal Reserve have no choice but to slam on the brake, to cool down the economy. And chances are they're going to send the economy into recession, okay? So the probability or the likelihood for our economy to go into recession later this year or maybe next year now is higher. So what it really means is that our economic growth will slow down. Corporate sales revenue will shrink. Margin will shrink, which lead to earning will be reduced. And that's why investor is no longer willing to pay the type of price to earning ratio, the high PE ratio that has been going on in the past couple of years. So that's why everybody is selling it, because they're expecting a much lower price to earning ratio. Now, 2 weeks ago, I released a video update. At the time, S&P 500 is at about 4,000. And at that time, the PE ratio, S&P 500 PE ratio is coming back to about 2021. And as I mentioned that historically, S&P 500 PE ratio typically is at about average at about 16-17%. And based on between 16-17% of PE ratio, we said S&P 500 should be at about 37.25. Okay, 37.25. And guess what? If you look at, let me go back to SPX. And today, S&P 500 closed at 37.35. Very close to 37.25. Now, given that the Fed is going to raise rates possibly 75 basis points, and in the next couple of months, and there's going to be another at least 50 and 50 is a given. So what the market now is saying that, well, it looks like the PE ratio is going to be further compressed. Why? Because economy is going to shrink or slow down. corporate earning is going to shrink. Okay, so we're talking about lower earning, so investor will only willing to pay a lower PE ratio. If we're looking at a new reduced or compressed PE ratio down to 14, then we're expecting S&P 500 will be coming down to even 32.25. Okay, so as you can see, the trend keep going lower and lower. So that's what we can expect. Now, is it going to go straight down to that level? Of course not. And as you can see, there's going to be some rally and the bear market rally, okay, up and down. So we have to know what kind of investor we are, okay? Are we trader? Are we speculator? Are we gambler? Or are we business owner? Okay, so you have to make that decision. Okay, so now knowing what to expect, so what should we do? Well, as I mentioned, if we do nothing based on the current inflation, our money will be reduced by half in just the number of whether it is 10, 8, 7, or even 5 years. Okay, because of our dollars keep devaluating, right? Everything is getting more and more expensive, and the only one way to deal with it is to keep on investing. Now, the good news is that given the market has been coming down, and for many of us who are value investor, and we've been preparing, we've been studying, we've been looking for great company, wonderful businesses. In the past 2 years, everything is priced so high, right? Being value investor, and we feel that everything is way overpriced. There's no way we're going to chase the market and chase the price, and that's not how we invest, right? We like those great businesses and we want to own them, but we will not own them at all costs. And guess what? Given the current market condition, it's bad for a lot of people, but if you have been following my program and following the process and using my tools, chances are you already have quite a few company on your target or on your watch list. And if you have done your homework, you already know exactly at what price the company is worth buying, right? So sharpen up your pencil and get ready, and there may be opportunity for you to back up the truck and load it up. Okay, now be very, very careful, because I think going forward, given everything that's happening, we can expect the market is yet to bottom out, and I think this whole thing won't play out until at least toward the end of this year, when the Fed gets through this cycle. And by the way, I haven't mentioned another thing is that in addition to increasing the interest rates, the Federal Reserve, they also need to reduce their balance sheet, which means that all those assets they had purchased in the past couple of years, they will have to start unloading it in the market, which means in addition to many investor or market participant, the Fed is going to be the seller in the market as well. Okay, so there's going to be a lot of selling. So for us, means opportunity when everybody else is selling in fears, and that's when we can find good deals. So in any case, if you're not familiar with my program, send me a message and get in touch with me. I'm more than happy to share more with you. And in fact, given the down market since January, what I can tell you is that many in my group are making money on a monthly basis when the market is up and also when the markets are down. Okay. All right. So take care, everyone. And hopefully this helped everyone to understand what's going on, why it happened, and why the Fed's doing what they're doing, and what to expect. By tomorrow, the market can go up, rally, because, the Fed finish their job, or at least for this month, and let's get over that and then move on. So the market may rally, or the market may drop another 1,000 points, whatever the case may be, but it doesn't matter. The market does what the market need to do. For us as investor, we only look at absolutely the best business, the performers, those who can weather the storm, and we will only invest when we get a good deal, when it's undervalued. Okay? All right. So that's it for now. Take care, everyone, and I hope everyone can hang in there and get through this turbulence time. Okay. All right. Until next time, take care. Bye for now.